Everything in the world moves in cycles. The changes from spring to summer, the daily occurrence of rush hour traffic, annual festival holidays, breakfast, lunch and dinner, yearly, quarterly, monthly, weekly, as sure as night turns into day and day turns back into night. We all live our lives in cycles, up and down and round and round. Ironically, when it comes to trading financial markets, the cyclical nature of supply and demand is hardly ever taken into account by the vast majority of traders. Yet market cycles remain one of the simplest and most reliable edges we can utilize throughout the year. Statistically, out of all the lagging indicators on offer, market cycles are one of the few genuine leading edges a trader can exploit on a day-to-day basis. Best of all, they are very simple to use and understand. We're going to look at 3 different examples of reliable market cycles and explain why and how they work. So prepare to see the clarity in the market you never would have considered possible, as this week we lift the lid on the subject of seasonal tendencies. Out of all the trading concepts we're looking at in this weekly series, this is my personal favourite. There is a massive edge to be gained from knowing which side of the market to play at a particular time of year. It really helps you in selecting the right market to trade and also gives you the confidence to hold your positions for outsized profits, as you know in the back of your mind the probabilities are on your side. Seasonal tendencies are really a kind of feedback loop, a well-worn historical path that works because traders follow them, and traders follow them because they work. We get yearly cycles of supply and demand in most markets, and many are very logical, underpinned by a solid fundamental foundation. For example, you'd expect increased demand in energy markets during the winter months and weakening demand during the summer when the climate is milder. Whilst that's a very simple illustration, it implies that there are patterns to levels of supply and demand that translate to price moves with a degree of predictability. There can be a very direct connection between price trends and seasonal tendencies. The fact traders anticipate those moves also reinforces the seasonality factor. Therefore, we can say that seasonal tendencies are markets' underlying natural rhythm. You need 4 main components. Number 1, the cycle low point or the seasonal low. Number 2, the market rise or the seasonal rise. Number 3, the cycle top or the seasonal high. And number 4, the fall or the seasonal decline. To define a market cycle, you need to backtest years of price data, but that's also quite a time-consuming and complex job. Thankfully, there's lots of online information and books written about the subject. A great place to start is the Moores Research Centre. They create some of the most detailed information about seasonal tendencies. In this introduction, we're going to look at 3 markets to demonstrate just how powerful this trading concept can be. They are the soybean market, the gold market, and firstly, the bond market.
So the chart that you can see in front of you is the US 30-year bond. It's the futures contract, indicated by the symbol ZB. The green line is our seasonal tendency for the bond market. We can't use every inflection within that green line as a reason to take a trade, but nevertheless there are some key moments within that general pattern, that general yearly cycle, which tend to be relatively consistent as trading opportunities. And they are generally the beginning of October, where we're looking for a rally in bonds, and also in April, a sort of like a drop in the bond price, and then a bottoming, and then a rally as we come out of May into June. There's very, very key reasons for that. The first reason is that in October, that marks the start of the fiscal year in the US. So there is an increase of liquidity, and there is also an easing of borrowing generally across the system as they start the new fiscal year. In April the 15th marks the final day of tax payments in the US. And what that means is the general anticipation of tightening, a general anticipation of tighter monetary conditions as people pay their taxes. Once the Federal Reserve starts to then recirculate money back into the system from the middle of May, June onwards, we then start to see an uptick in the price of the bonds. So if you can see on the chart here, I've put that in. This is a daily time frame chart, and you can see I've put those areas in. So you can see in April, you see that tightening effect, and then that rollover, and then that push higher as we move into the summer months in June and July. And then in the October time, we just see that pickup in activity from October into November, and that tends to be relatively consistent. And it doesn't really matter what the overall trend of the bond market is. Those times of year, that type of behavior tends to be relatively consistently displayed, and it can be used as a backdrop, as a trading concept. So what's very interesting at the moment is that basically now we're in that time period again, as we are at the end of October into November, and we'll be looking for some general bottoming in the current bond prices around here, and some kind of a movement, some kind of support in the market that could create a rally from here for the next month or so. The next market that we're going to look at is the soybean market. This is the futures contract, ZS, and here you can see the seasonal tendency overall for the 12-month period. I bring your attention to these two areas here, February, late January into February, and also May, sort of mid-May into June. Those are the two key areas, I think, from a seasonal tendency point of view. We're looking for a flattening in price action in February, and also a rollover in prices, a drop-off in prices during May into June. And that's really because of the two key players in the soybean market. Firstly, you've got the United States, and you've also got Brazil, both major producers of soybeans. But ironically, they both grow and harvest the crops and bring them to market at different points in the year. And those are the fundamental forces which create this very, very strong seasonal tendency. So if you look at the chart itself, you can see it here. We get flattening of price action during that February period, a sideways market, as the US markets their harvest and Brazil starts to develop their own crop. By the time that starts to run out, that supply runs out in the US, we start to see the pressure on the soybean market as prices start to rise, as there's a lack of soybeans in the market. It's not until May rolls around that Brazil start to then take their crop and then start to sell it into the market, and we see that supply coming during May time, and it generally, as a rule, rolls the prices over. And you can see that is relatively consistent here. That's May into June 2021, and then again May into June 2022. So as a seasonal tendency within an agricultural product, you've got a great combination of weather and supply and demand, and the major players in the market that have to pretty much do the same consistent types of things every year, and that's a very strong seasonal tendency within the soybean market. The final market that I want to look at is the gold market, and this is the seasonal tendency that you can see in front of you here. Potentially my favorite one. I've traded this one very successfully myself this year, made some good returns on trading gold at the end of the summer, and this tends to be a relatively consistent seasonal tendency as well. The area that I'm looking at is this area from August into October, this depression in prices and then this general flattening and then picking up in activity as we move into October. And there's a very, very good reason for that, and that is the beginning of the Indian wedding season. Now, gold is culturally incredibly important in Indian cultures, and when there are weddings, when people get married, gold is a big factor of the wedding. It's not unheard of for Indians to spend 25% of the wedding budget on gold itself, for decorations, presents, investments, that kind of thing, jewelry. So it's a really big thing, and we're looking generally on average is around about 20,000 new weddings in India between October and December every single year. So it plays a really big factor, and we tend to see that the price of gold will generally roll off a little bit at the end of the summer before it then picks up into the start of that wedding season, and that's exactly what I traded this year. Now, if you look at that on the chart, you can see how consistent that tends to play out. You can see here this rollover in price here in October before we in August, before we then get this pickup of activity, this flattening, and then this rally here up in October into November as well. And it's the same the year after as well. You get a rollover in price here in October, and then from September, October, you then get that pickup again in activity. And this is the move that I traded this year for my own trading, and a similar sort of deal. That August, end of the summer, we tend to get good shorting opportunities in the market and a flattening, and then we start to see that pickup in activity as Indians start to enter the market and purchase gold.
Hopefully you can now see the advantages of playing the markets throughout the year from a foundation of understanding how seasonal tendencies affect the price action. The great thing about this trading concept is that it suits every trading style. It doesn't matter if you're a scalper or a swing trader, a day trader or a long-term position holder. Seasonal tendencies are the strongest connection I've found between time and price. Once you've picked up the rhythm, you can work within a set window of time and trade from a position of confidence. And don't forget to check us out on all the socials, subscribe to the channel, and please do leave us a comment below. Next week, we will take a good look at the concept of trading spreads.